Well, while big tech breaks out to new highs, it may be crunch time for Lululemon. The stock is down again today, bringing its losses to 44% for the year, and it hit lows dating back to October 2022. BMO's top retail analyst warns the athleisure brand faces a watershed moment. Simeon Siegel follows Lululemon for the firm. He's got a market perform rating and a $384 price target. Simeon, it's always good to see you. I mean, I guess the question is, is this sort of a one-off bad season, or is this a more prolonged sort of slump that Lulu is in? Is the verdict still out, or are you ready to make decide?
Wouldn't it be nice if I just said yes? So I think that's the question. I think you and I have talked about in the past, we've talked about on the show, this notion that brands hit ubiquity levels. Brands become not cool at a certain level. And that level, my team has done phenomenal work on this, so thank you to them. But what we have found is $3 billion in North America is that level. And so companies go above it, and then they come crashing back down. And so Lulu right now at over $6 billion looks much higher. Now, Guy's going to come at me and say, well, where's Nike fit on that? And the answer is there are exceptions. And so we need to figure out, is this an exception? What you look for is whether the sales are eroding, the quality of sales are eroding. Do they have to discount to get those revenues? Last quarter, they did.
So let me ask you, we've seen turnaround plays before. I think of Ralph Lauren as one, right? Where it surpassed that $3 billion. It's north of $6 billion. The brand was ubiquitous, and it seemed to be sort of tainted somewhat. And yet they were able to do it. What did they do there that you think Lulu could or can't or won't be able to do?
So I'm half glad you're asking me that, half not, because so one thing that we did.
I'm still waiting for Guy to come in.
Well,
that was a preemptive strike.
I got it before he did it. Wasn't that good?
I get it. I would have done the same thing.
I got it beforehand.
Yeah.
Like I'm here. So it's $3 billion of sales at retail. So what that means? So these companies report their revenues, but Ralph is a wholesale business, and so if you strip out the business and you add that up, they're actually it looks different. And so that's really important because I don't really care about what revenues a business recognizes. I care about what level a consumer spends. And so a lot of these businesses, you watch Ralph, you watch Coach, you watch Michael Kors, you watch these businesses go higher with wholesale, which helps. Lulu doesn't have wholesale to any real extent, but then they actually did come back down. And so part of what Ralph did so well is they appreciated this idea that you can sell less and charge more and make more money. You can raise your price. And we learned this in Econ 101, price elasticity. I can make a lot more money by being more exclusive. We all want to be inclusive. We want to sell to everyone, but the reality is you don't.
But Simeon, so I hear your concerns, and you're talking about ubiquity. That sounds like it's almost brand specific because that's what happens to brands. I hear you talking about levels that you and your team have at least determined are where companies run out of gas. This sounds as much like a macro story as it is a company-specific story. I think it's both. I actually think it's a case where I think the macro is just as bad as the specific story, and I think the pull forward from COVID is one of the most extraordinary things we'll ever have seen if you're a company like Lulu, especially in athleisure when Guy sat around at home in his yoga pants and didn't have to really put a suit on until last week. So is it Lulu or is it the consumer?
So this is what I love that you guys do so well. You can take a company, strip it down to not what they do and look at the numbers and say, okay, how is that working in a way that other people cannot? If you look at Lulu's numbers relative to the group, subpar last quarter. Yeah. It's always been better. Its gross margin dramatically underperformed. And why did it underperform? They marked stuff down. I don't cover LVMH. I don't know. I didn't hear them talking about marking stuff down. So there's macro that hurts a lot of people, but what you're watching is relative to the group. If I were to delete the 4 LU and just showed you the performance, you would look at this and say, well, should I be paying 20 times? Then you would say, going back to your conversation right before about the market multiple, and you say, well, Lulu historically has always traded above. So that's this give and take. Okay. And so what you can come back and say to me is, okay, how was their inventory? And what I would say is their inventory was really clean. And so what retailers do when they make a mistake is they discount, they clean, they start again. That's why we're not ready to make that call. Because what could happen, it could be that Lulu had a mistake. They had a fashion miss. So beyond just macro, they actually had a company-specific miss. Isn't that nice? I get to say those. I'm a retail analyst.
That's great.
Yeah. But what about the? I mean, the margin is flat for the last 2 years, and it's a bump, from 55% 2 years ago up to 58 or so. And you look at a Nike down there at 46% or so, and I think it's probably more macro if you think about it. So, do you not believe the double-digit expected earnings growth and sales growth with a flat margin, next year? Because if you do, then trading at 18 times, you just don't have too many opportunities to buy a company like this that doesn't have a specific issue.
If you believe, and this is where that $3 billion number matters. And we've seen so many companies, I've had so many conversations with so many people in different corner offices that say, okay, I get it, I can see it, but it's not relevant to me. If you believe it's relevant to them, you and I are not going to be seeing this revenue number go up. It's not a question of how much it's going to grow, it's actually going to shrink. The question is when. And if it shrinks, you're at a 23% EBIT margin that doesn't really exist in retail. That's a very high sales per square feet. You're talking about Apple before. They have Apple-level sales per square feet. If that goes the other way, that 23 EBIT margin, which is almost double Nike's EBIT margin, starts going the other way too.